AI is booming. But if spending slows, profits disappear, or debt explodes, this bubble could crash faster than you think. Thanks for watching. If you enjoyed this video and want more investing and AI market insights, make sure to subscribe now. Make sure to subscribe now. Thanks for watching. Don't forget to like, subscribe, and turn on notifications for more videos about money, investing, and the future of AI.
The AI investment bubble, are we heading for a crash? Imagine waking up one morning and discovering that some of the biggest technology stocks in the world have suddenly fallen 30, 40, or even 50%. AI companies are struggling. Data centers are sitting underused. Investors are desperately trying to sell. And the companies that looked unstoppable just months earlier are suddenly being questioned. Sounds extreme. Maybe. But here's the uncomfortable question. Are we watching the beginning of an AI investment bubble? Artificial intelligence has become one of the biggest investment stories in modern history. Billions and potentially trillions of dollars are flowing into AI chips, data centers, cloud computing, startups, power infrastructure, and software. Investors are betting that AI will transform the economy. And they might be right. But there's a problem. Sometimes the greatest technologies in history can still produce terrible investments when investors pay too much for them. That's exactly what happened during the dot-com era. The internet was real. The technology was revolutionary. But many internet stocks were priced as if every company would become the next Amazon. They didn't. And today, some investors are asking whether AI could be following a similar path. So let's break down what's actually happening. Is AI really a bubble? Could the AI market crash? And more importantly, what should ordinary investors do if it does? Part 1, the AI investment explosion. Let's start with the obvious. AI isn't just another technology trend. Companies are spending enormous amounts of money trying to build the infrastructure required for the AI economy. That means GPUs, data centers, networking equipment, electricity, cloud computing, specialized chips, and increasingly massive amounts of debt. Goldman Sachs economists estimate that AI investment could reach roughly $600 billion in the United States during 2026, representing around 2% of GDP and a significant portion of business investment. Other estimates are even larger. One recent analysis suggested that total AI spending could approach $800 billion this year when major infrastructure investments are included. Think about what that means. Companies aren't spending millions. They're spending hundreds of billions. And investors are assuming that this infrastructure will eventually generate enormous profits. That's the key word. Eventually. Because much of the AI investment happening today is based on expectations about tomorrow. Part 2, the biggest question, where will the profits come from? Here's where things become interesting. Building AI infrastructure is incredibly expensive. A company can spend billions constructing data centers and buying chips. But spending money isn't the same thing as making money. The real question is, will the revenue generated by AI be large enough to justify all this spending? That's still difficult to answer. Amazon, Microsoft, Alphabet, Meta, Oracle, and other major companies are investing heavily in AI infrastructure. But separating AI revenue from their broader cloud and technology businesses isn't always easy. And that's creating a strange situation. Investors are pricing companies based on the future potential of AI, while the actual return on those investments is still developing. Reuters recently reported that the capital expenditures of major AI-focused hyperscalers could rise much faster than their operating cash flow, putting pressure on free cash flow. That doesn't automatically mean a crash is coming. But it creates a vulnerability. Because if companies keep spending faster than AI revenues grow, investors eventually start asking, when does this investment actually pay for itself? Part 3, the debt problem. Now we get to the part that could make an AI downturn much more serious. Debt. In the early stages of a boom, debt can accelerate growth. Companies borrow money. They build infrastructure. Infrastructure creates capacity. Capacity creates revenue. And everyone wins. But what happens if expected demand doesn't arrive? The debt doesn't disappear. The payments remain. And that's why financial regulators are paying attention. The Bank of England has warned that the increasing use of debt and more complex financing structures for AI infrastructure could create financial stability risks. Private credit has also become increasingly important in financing AI investment. The Bank of England noted that private credit financing accounted for a much larger share of AI investment in 2025 than in 2024. This matters because the AI boom isn't happening entirely with cash sitting on corporate balance sheets. Some of it is being financed through increasingly complicated capital structures. And whenever a massive investment boom becomes dependent on continuous financing, the system becomes more sensitive to higher interest rates, falling stock prices, and weaker investor confidence. Part 4: The NVIDIA effect. Now let's talk about one company that sits at the center of the AI investment story. NVIDIA. NVIDIA has become one of the most important companies in the entire AI ecosystem because its chips power many of the world's most advanced AI systems. But NVIDIA's importance goes beyond selling chips. Its ecosystem is increasingly connected to AI startups, infrastructure companies, and financing arrangements. In August 2026, NVIDIA was involved in a massive initiative with major Wall Street firms aimed at financing as much as $500 billion in AI infrastructure. That's an extraordinary number. And it tells you something important. AI isn't just a technology story anymore. It's becoming a financial story. Banks are involved. Private credit is involved. Institutional investors are involved. Public markets are involved. And giant technology companies are involved. That means if AI investment continues producing strong returns, the economic impact could be enormous. But if expectations suddenly collapse, the consequences could spread far beyond individual AI stocks. Part 5: The dot-com comparison. This is where the comparison with the late 1990s becomes tempting. During the dot-com boom, investors believed the internet would change everything. They were right. But they made one major mistake. They assumed that because the technology was revolutionary, every company connected to it would become extremely valuable. That wasn't true. Thousands of internet companies disappeared. Some had no meaningful revenue. Others had terrible business models. Some were simply priced far above what their future earnings could justify. Eventually, investor confidence changed. And when it did, the bubble collapsed. Today, AI is different in one very important way. Many of the biggest AI companies actually have real revenues, real customers, real infrastructure, and real profits. This isn't a market filled entirely with companies that have no business model. That's why saying, AI is just another dot-com bubble, is too simplistic. But there is another possibility. AI itself can be real, while some AI investments can still be overpriced. That's the distinction investors need to understand. Part 6: What could actually trigger an AI crash? So what could cause the bubble to burst? There isn't one single answer. There could be several triggers. Trigger number 1: AI spending slows. Imagine Microsoft, Amazon, Google, and Meta suddenly decide they don't need to spend as aggressively on AI infrastructure. Demand for chips falls. Data center projects get delayed. AI suppliers see slower growth. Investors begin lowering their expectations. And stock prices fall. One company's spending is another company's revenue. That's why a slowdown at the top of the AI ecosystem can travel through the entire supply chain. Trigger number 2: AI doesn't produce enough profit. This could be even more important. Imagine AI becomes incredibly useful. But companies discover that monetizing it is harder than expected. Customers might love AI. but they may not be willing to pay enough to justify enormous infrastructure costs. That creates a dangerous gap. Asterisk huge investment on one side, limited profits on the other. Eventually, investors notice the difference. Trigger number 3, interest rates stay high. AI infrastructure requires massive amounts of capital. If borrowing becomes more expensive, the economics of building data centers become more difficult. And companies with weaker cash flow become more vulnerable. This is particularly important because AI infrastructure is increasingly being financed through debt and other forms of external capital. Trigger number 4, competition changes everything. AI is developing incredibly fast. A company can spend billions building a powerful model. And suddenly a competitor releases a cheaper or more efficient model. That can destroy the expected economics of an investment almost overnight. If AI becomes dramatically cheaper to produce, that's great for consumers. But it could be painful for companies whose valuations depend on extremely high spending continuing indefinitely. Part 7, what happens if the AI bubble bursts? Now let's imagine the worst-case scenario. AI stocks fall 30%. Then 40%. Investors panic. Companies delay data center projects. The biggest winners may not be the investors who predicted the crash. They may be the investors who were prepared for it. This is Bin Invest, where we break down money, investing, and the forces shaping your financial future. Subscribe for more.